Good afternoon, everyone. We extend a warm welcome to all of you for yet another insightful session in the Brain Gain Expertise series, focusing on the critical topic accounting for income taxes, a comprehensive review and update, organized by the Accounting Standards Board of the ICI. This session marks the sixth in our valuable series, which aims to deepen understanding of the practical applications of accounting standards through expert led discussions and knowledge sharing. We are privileged to welcome our esteemed speaker for the day, CA Surinder Jain. A very warm welcome to you, sir.
Thank you.
Before we move into the technical session, allow me to take a moment to introduce the moderator for today's session, CA Shubham Singla. CA Shubham Singla is a qualified chartered accountant with practical experience of more than 8 years in accounting, auditing, and taxation across multiple industries. He is working with one of the leading telecommunication companies. He has assisted large telecom and IT clients on financial reporting and accounting matters, including accounting advice on complex transactions. He has been rendering trainings on various accounting topics within organization. With that, I now invite CA Shubham Singla to take this session forward by introducing our distinguished speaker for today, CA Surinder Jain. Over to you, sirs.
Thank you, Rahul. Hi, good afternoon, everyone. I'm Shubham, your moderator for today's session. I welcome you all for joining this session, and especially our eminent speaker, Mr. Surinder Jain, who is a qualified chartered accountant having 20 plus years of experience. He's a chartered accountant, he's a US CPA, and he has worked across different industries. In past, he has worked across EY, KPMG, and he has worked upon various complex transactions. I welcome a warm welcome to you, sir, and I think I hand over to you now for continuing the session.
Sure. Thank you, Rahul. Thank you, Shubham, and good afternoon, everyone, for taking out time and attending this session. So today we are going to talk about income taxes, which is in income tax we'll cover two standards largely: Indian GAAP standard AS22 and Ind AS standard Ind AS 12. Ind AS, as you know, is a corresponding standard to IFRS as we move to IFRS in around 2016. So most of the companies in India, large companies, are also following Ind AS, so that is also very relevant. And then once we cover these two standards, we'll also talk about some of the key updates which has taken place in last couple of years, followed with the Q&A round. During the session, if you have any questions, feel free to drop that on the chat box, and our moderator keeps a track of it. And at the end of the session, we'll take those questions as the time permits. So with that, we jump onto the session. I'll share my slide deck. So I've just shared my screen. Hope it's visible to all. Okay. Yeah, so this is the broad agenda we have. So we'll start with introduction to income tax accounting, and as I said, we'll largely cover two main standards: AS 22, the erstwhile Indian accounting standard, the old accounting standards, followed with Ind AS 12. Then we'll also cover some of the key differences between these two standards. Differences become relevant, especially for, let's say, some of our professionals who are working and helping various companies, and some of them may be following Indian GAAP, and some of them may be following Ind AS. To that extent, the differences also becomes relevant, and some companies during their course of progression may also be moving from their previous Indian GAAP to Ind AS. So we'll cover those differences, then some of the updates, and at the end of the session, we'll take up the Q&As. So first question, which is most relevant here, is why income tax accounting matters, right? So this question is relevant because what happens is typically we say, okay, we prepare our financial statements based on applicable accounting standards. But at the end of the year, when it comes to tax, we move to income tax. We apply income tax provisions to various items of our financial statements, starting from income statement, and see and evaluate what is the treatment prescribed under income tax for the respective item. So the purpose here is basically aligning financial accounting and reporting with tax obligations, right? And ensuring accurate representation of tax impacts. So as I said, what happens in when we prepare on our financial statements on a day-to-day basis, and when we prepare our financial statement at the end of the relevant reporting period, those calculations are done as per accounting standards. But when it comes to tax, we move to the tax. So in order to avoid that mismatch, the standard were issued that for calculating tax provisions for accounting, we should also follow the same principle of accounting and avoid the mismatch, so that the tax impact is calculated in accordance with accounting profits and not necessarily based on tax profits. So if there is a mismatch between, let's say, tax difference between tax profits and accounting profits, the relevant provisions of these standard comes into picture. And there are detailed discussion on these standards, and depending upon the complexity of the transactions in each organization, this standard becomes very exciting. Okay, so the relevance, as I said, is critical for stakeholders to understand companies' true financial position with a tax impact. So when we have our financial statements or financial position where tax is calculated as per tax, there is this slight mismatch, and these standards try to address that mismatch. So these are the two standards we'll cover: accounting for taxes on income, which is erstwhile AS 22, and then Ind AS 12 income taxes. And Ind AS 12, some of you might already know, is derived from IS 12, which is the IFRS version of global standards. And in this standard, there are no deviation, and most of the provisions of the standards are aligned with the global standards. So starting with AS 22, accounting for taxes on income. So the objective of the standard is govern the accounting for taxes on income under Indian GAAP and focusing on current and defer tax. So these are the two concepts which are there both in both the standards: the current tax and deferred tax, right? And the scope of the standard, in my view, for AS 22 is limited, because most of the large and mid-sized entities in India have moved to Ind AS, but there are, of course, several entities still which follows old Indian GAAP. So this applies to entities which are still following Indian GAAP. So if any entity is following Ind AS, of course, the AS 22 discussion is not relevant for them. And we know that, okay, there was a detailed roadmap which was laid down by the MCA when India moved to Ind AS, and there was various thresholds limit like 500 crores net worth, 250 crores net worth, etc. So based on that, respective companies evaluate and assess that whether they prepare their financial statements under Indian GAAP or Ind AS. So we all have come through that stage. So we know that, okay, which company is following Ind AS or IFRS. So in this case, AS 22 is relevant for companies which are following Indian GAAP. The key concept under Ind AS 22 is this: the approach followed under this standard is timing difference based approach, which is we call profit and loss account approach. So and which is contrast with Ind AS 12, where we follow balance sheet approach. Some of you might have heard this, that when we apply Ind AS 12, we follow balance sheet approach, whereas Indian GAAP or AS 22 is typically we prepare based on profit and loss account approach. So we'll see how that is different. So let's see some of the key concepts. And when we're talking about these concepts, some of them are same both under AS 22 as well as Ind AS 22. So current tax, as the name suggests, tax on taxable income for the period recognized in the statement of profit and loss account. So what is current tax? Current tax is when we calculate our tax obligation as per applicable tax laws. Right, so it's effectively the current tax, which is the, let's say, cash payout which we pay if there's a tax obligation throughout the year through advance tax, and then at the end of the year the final tax obligation. So any tax which is calculated in accordance with the applicable tax laws becomes the current tax. Deferred tax, that's the essence of both these standards. tax effect of timing difference between accounting income and taxable income. So what we are saying here, that we all know that our accounting income, the income as per financial statement, may not all the time be same as taxable income. There are areas of differences, and our taxable income is generally different from accounting income. So we need to, under these two, both the standards, we are generally identify these differences, and then under AS22, we categorize or mark those differences as timing differences. Right? So first we say, okay, what is my accounting income? Then I say, okay, what is my taxable income? And I identify those differences, and then I then evaluate the tax effect of those differences. So I call them I mark them as either timing difference or permanent difference. If you see last 2 points on the slide, those differences are marked either as timing difference or permanent difference. Timing difference, as the name suggests, arises due to difference in the timing of income and expense recognition. And some of the typical differences are, let's say, depreciation, provisions. So further, those timing differences are categorized in two parts. Either those timing differences are taxable timing difference, or they are deductible timing differences. So what is a taxable timing difference? This will lead to future tax payments. So in a taxable timing difference, what happens? At present, we end up paying a lower tax, but this will result in higher tax payments in future. So one of the typical example is higher accounting depreciation than tax. So in accounting books, generally we charge a lower depreciation, and in tax rules, we charge higher depreciation. Right? So which means we will end up claiming lower depreciation in future, which will give rise to higher tax obligation. So that becomes a taxable timing difference. The opposite of that is deductible timing difference. Deductible leads to lower tax payments in future. Means because of the relevant tax provisions, we ended up paying higher tax in present, and in future this will result in our lower tax obligation. So for example, we have made a provision which was disallowed by tax, but it will be allowed in future. So that's an example of deductible timing difference. And lastly, permanent difference, the differences which do not reverse in future. So for example, if an expense is disallowed for tax purposes, right? So that difference, while giving rise to current tax, that difference is not going to reverse in future. So that becomes a permanent difference. So to summarize, what happens in Indian GAAP is we take taxable profits or profits as per tax. We take profits as per our books. We identify all those differences. We mark those differences as timing differences, and then within timing differences, then we mark them into two categories, whether they are reversible timing difference or permanent differences. So we do not take any action for permanent differences because they are not going to result in any future tax consequences. But for temporary timing differences, we mark them as deductible temporary differences or taxable temporary differences. Yeah. So after we have identified the differences under AS22 and mark them as temporary differences, the next step comes is measurement. And we are going slightly, let's say, if these are not new concepts, and we have been practicing this for many years, I would say now. So I think it's more of a refresher as opposed to, let's say, doing a deep dive. But at the same time, if you have any questions or you think we need to kind of discuss something in detail, we can always take that as part of Q&A at a later stage. So after identification of temporary differences, the measurement. So how does the measurement happen? Deferred tax based on tax rates, enacted or substantially enacted, applicable at the reporting date. So once we have identified the difference, we have to measure that to compute the deferred tax. So in order to have a deferred tax, what is prerequisite? We have to have a reversible temporary difference. It may be deductible, it may be temporary, it may be taxable, but there has to be a difference. on which deferred tax calculation is required. Now, in order to calculate, we need a tax rate. What tax rate we take? We take enacted or substantially enacted applicable, enacted or substantially enacted tax rate, which is applicable at the reporting date. So that rate, let's say if rate notified is 35 or 25%, so we apply that rate. We also factor in relevant surcharge or other cess, etc., if applicable, in computation of those deferred taxes. Okay. Now, when we talk about deferred taxes, depending upon the nature of the differences, deferred taxes are further bifurcated into two parts or two categories. What are those two categories? Deferred tax differences are results in deferred tax asset or a deferred tax liability, DTL or DTA. So based on the and that is dependent on the nature of difference. If it is going to be deductible temporary difference, what will it generally result in? We are going to get a higher deduction in future, right? So if we are going to have a higher deduction means lower taxes in future. So we are going to have an asset in that case. So we will create a deferred tax asset. If we are going to have a higher tax obligation in future, which means it's a taxable temporary difference, that is going to result in DTL, deferred tax liability. So after so for measurement, we apply enacted or substantially enacted tax rate, and we, based on the nature of differences, we categorize those differences as we identify those differences as deferred tax asset or a deferred tax liability. Now, the standard says that if it is a deferred tax liability, we straight away apply that enacted or substantially enacted tax rate to deferred tax liability, and we record that in financial statement. But there is a stringent criteria or additional steps to be followed if it results in potential deferred tax asset. We all know that for assets, we follow this in general accounting, we follow the concept of prudence, right? So when we are recognizing deferred tax asset, we standard requires us to perform additional sanity check or laid down additional procedures before that deferred tax asset can be recognized. So recognize deferred tax liability straight away. No additional steps or activity required. But if it is a deferred tax asset, a company cannot straight away record it. They have to assess that deferred tax asset recognition, and they can recognize, you see point number 2, only to the extent there is something called a reasonable certainty that sufficient future taxable income will be available, right? Because how do we generally when we record asset, we need to recover it after either through usage of that asset or through realization. So in this case, deferred tax asset, there is no as such usage like a PP. We have to recover that through a realization. So for in order to assess that realization, there has to be a reasonable certainty. So mark this term under AS 22. The term used for recognizing deferred tax asset is reasonable certainty. Okay, and it's important when we'll compare that with AS 22. Third point, DTA, there is additional much more stringent criteria in case an entity has unabsorbed depreciation or carry forward of losses. So in point number 2, we are saying that recognize deferred tax asset if there is a reasonable certainty. Then standard goes on to say that if you are an organization which has unabsorbed depreciation or carry forward losses, then you have to apply even much more stricter criteria, and that criteria is there has to be a virtual certainty supported by convincing evidence that sufficient future taxable income will be available, right? And this is logical in a sense that if you are an organization which is incurring losses, or you have brought forward losses, or you have unabsorbed depreciation, which means your current income is not sufficient to absorb your depreciation, or you are incurring losses, then how are you going to generate sufficient income in future which will help us realize the deferred tax asset? So that is where the standard says that in case you are an organization where an unabsorbed depreciation or a brought forward losses is there, you have to establish that there is a virtual certainty which is supported by convincing evidence before a deferred tax asset can be recorded. So very, very important point. And as these words are obviously easy to understand, or we say virtual certainty, but compare it with the practical scenario. If you go to an organization and ask, okay, how do you establish virtual certainty? And this is one of the harshest term in terms of probability and others, which is used in any standard, either in Indian GAAP or IFRS, where they are using this term virtual certainty. So virtual certainty is which is almost going to happen, which is certain, which is very close. There is highest level of probability that event is likely to take place, which is company is expected to be in profits. How an organization will establish that? Right? So as a professional, both within the company as well as external advisors, it becomes very critical and a cumbersome job for people to establish this. And more practically, hardly you'll find an organization which will end up recognizing deferred tax asset in such cases. In the point number 2, if an entity does not have losses or unabsorbed depreciation, a reasonable certainty, still there can be an evidence to support that. But there will be rarely a case where company is able to establish virtual certainty, which is supported by convincing evidence to record deferred tax assets. Okay, so that's the essence of AS22, where we say compare your current tax and then you compare your accounting income with taxable income, identify those differences, mark those differences as temporary or permanent. Timing difference, the term used in Ind AS 22 is timing difference. Mark those timing difference as taxable or deductible. Then then you apply the enacted or substantially enacted tax rate. Then if it results in deferred tax liability, record it. No additional steps required. If it results in deferred tax asset, apply the reasonable certainty test for recoverability. But if you are an organization which has unabsorbed losses or brought forward losses, carry forward losses, then you also apply another stringent criteria, which is virtual certainty supported by convincing evidence. Last point, presentation. How do we present deferred taxes? So under Indian GAAP, we can offset deferred tax asset against the liability. So net of the two is presented in the balance sheet. So suppose your deferred tax asset is 100 and your deferred tax liability is 80. So you end up recognizing net deferred tax asset of 20. Whereas Ind AS do not permit offsetting. There is a criteria under which an offsetting may be allowed, but generally the deferred tax asset and liabilities are presented separately. Now let's see a very simple example on AS22, which talks about the deferred tax liability. In this example, it results in deferred tax liability. So there is a machinery which is purchased for 200,000, 2 lakhs, and the enacted tax rate is 30%. Year 1 depreciation as per books is 40,000, and year 1 depreciation as per tax is 80,000. Okay, so we have charged an additional depreciation. Tax depreciation is higher, so it results in timing difference of 40,000. In this case, our taxable income will be higher or lower. Since we are charging higher depreciation in tax, our taxable income will be lower. It is a timing difference. Why it's a timing difference? Because if you are charging higher depreciation now, you will be charging lower depreciation in future in tax. And in accounting, it will be opposite. You are charging lower depreciation now, and you will charge higher depreciation in future, because the cost of asset remains same both under tax and accounting. So in this case, timing difference is 40,000. The tax rate is 30%. So we apply 30% on this 40,000, which results in deferred tax of 12,000. Now this confusion or this let's say extra analysis always comes into picture, that it's easy to identify the difference, but whether the difference results in deferred tax asset or deferred tax liability. In this case, we are saying it's a deferred tax liability. Why we say that? Is it a deductible temporary timing difference or a taxable temporary timing difference? It's a taxable timing difference, because it is going to have a higher taxes in future, because your expense will be lower. So it will become a taxable difference in future, which results in deferred tax liability. The journal entry in this case will be tax expense 12,000 and a deferred tax liability of 12,000. Tax expense will go to your profit and loss account, and deferred tax liability account will go and sit in your balance sheet. Straight example, no complication. This is the most simplest example one can have to understand deferred tax liability, and it's equally applicable. The approach is different, but the computation is similar. Let's say under Ind AS 12 as well as AS 22. We'll see that as well. So this is one example on deferred tax liabilities. Moving on, warranty provisions. So there's another scenario where the company has made a warranty provision of 100,000, which is recognized in year one. And we know generally provisions in tax are allowed when they are paid or services are consumed. So obviously it is not allowed for tax laws. So deductible for tax when paid in year three. So company has made a provision of 100,000 in year one, but this payment has been done in year three. Similar to previous example, enacted tax rate is 30%. Now the calculation. So again, first thing, is it a timing difference? Answer is yes. Why? In accounting, we have recorded it in year one, whereas in tax, we'll get a deduction in year three. So it's a timing difference. Is it reversible or non-reversible? It is reversible. It's getting reversed in year three. So 100,000, 1 lakh rupees into 30%. 30,000 is the deferred tax. Now, is it an asset or a liability? Is it deductible difference or a taxable difference? Since you are going to get a deduction of warranty expense in future, it becomes a deductible difference. So we get a deduction of 100,000 in future. So it is likely to result in deferred tax asset. Deferred tax asset of how much? 30,000. Now, we discussed that if a difference is likely to result in a deferred tax asset, we apply another step, and in this case, we will recognize it only if a reasonable certainty of future profits exists. Right? So, unlike previous example where for deferred tax liability, we straight away recorded 12,000, here 30,000. For recording 30,000, that additional criteria will be applied. The journal entry will be, it results in deferred tax asset. So there will be a debit, deferred tax asset 30,000, and a credit of tax expense 30,000 if recognized, of course, and it will be recognized subject to reasonable certainty criteria. So that's a brief overview of AS22. Again, most of the concepts we know and we have been practicing for many years. So we discussed that. Now we move to Ind AS 12, which is corresponding or similar to IFRS standards, and the corresponding IFRS is IS 12. So it's derived from there. What is the objective of Ind AS 12? Prescribe accounting for income taxes covering current and deferred taxes to reflect tax consequences of transactions. So some of the principles you will see are similar to AS 22, but the method and approach, how those deferred taxes are calculated are different, and Ind AS 12 generally results in more deferred tax being identified as opposed to AS 22. So similar to AS 22, it prescribes accounting for income tax and covers both current and deferred tax. It applies to all entities preparing financial statement under Ind AS. Needless to say that obviously if an entity is following Ind AS, then this standard will come into picture. Alignment, it's aligned with IS 12. The focus is on balance sheet approach for tax accounting. So here is the punchline. Unlike AS 22, where we follow profit and loss account approach, P&L approach. Under Ind AS 12, we follow something called balance sheet approach for tax accounting. So the whole methodology or the approach how we calculate deferred taxes under Ind AS 12 is completely different from AS 22. Again, depending upon the complexity and nature of the transactions an entity may have, sometimes both the standard may result in similar deferred taxes, or it's highly likely that if an entity applying Ind AS 12 to its financial statement, deferred taxes will be different from what was computed under AS 22. So what are the key concepts of Ind AS 12? Some of them, as I said, are similar to AS 22. So current tax, same as Indian GAAP, tax payable or recoverable for current period based on taxable profit and loss as per applicable tax laws. So whatever we calculate as per applicable tax laws, that becomes our current tax. Deferred tax effect of temporary difference between accounting and tax basis of asset and liabilities. Right. So this here the terminologies and the definition is different from AS22, and some of the key terms which they are using. Tax effect of temporary difference. So here the term they are using is temporary difference, whereas AS22 typically use timing difference. So tax effect of what? Tax effect of temporary difference between accounting and tax basis of assets and liabilities. So here in the AS22, what did we say? Between accounting profit and taxable profits. Whereas here, what we are saying, between accounting base and tax base of assets and liabilities. And since they are using this term, accounting and tax base of asset and liabilities, immediately the focus shifts to balance sheet. And that is why we say Ind AS 12 is based on balance sheet approach. Temporary difference, essentially the definition wise is similar to AS22. So temporary difference can again be taxable or deductible. What is a taxable temporary difference? Leads to future tax payments. So you are going to pay higher taxes in future, higher depreciation than accounting. Deductible leads to future tax saving, provision deductible later. When do we recognize deferred tax? We recognize deferred tax for all temporary difference, similar to let's say AS22, where deferred tax was recognized for all timing differences. We recognize deferred tax for all temporary difference except the specific exemption. For example, initial recognition of goodwill. So Ind AS 12 gives us certain exemptions in which generally deferred tax is required to be recognized on all temporary difference, but there are certain conditions in which even though it may result in a difference, but deferred taxes are not recognized. We will cover that briefly at a later stage. But for now, market that deferred taxes are recognized on all temporary differences. So in the previous slide, we used two key terms. We said deferred taxes are recognized on temporary difference for if there is a difference between book base and tax base. So let's understand these two terms. Book base can also be known is also referred to as accounting base. So what is a book base? And this is called balance sheet approach. The carrying amount of an asset or a liability as recognized in the financial statement prepared under applicable accounting standards. So book base is much simple. Whatever are the carrying value of respective asset and liability in my financials, which are prepared as per applicable GAAP, that becomes my book base. And it reflects the value after any accounting adjustments, be it depreciation, provision, impairments, fair value, etc. So if you have done any adjustments to that item of financial statement in balance sheet, that needs to be adjusted. So effectively, it's your carrying amount in your balance sheet as per accounting. The example is, simplest example is machinery with a cost of 100,000 depreciated by 10,000 using SLM has an accounting base of 90,000. So in this example, the book base or the accounting base will be 90,000. So accounting base, book base is always easier. Tax base, the amount attributable to an asset or a liability for tax purpose. Okay. For an asset, it is typically the amount deductible against future taxable income. What happens when we acquire an asset? We recover it through future deductions, right? As I said in the earlier, either we recover an asset through realization or through usage, right? So generally, when you recover it through usage, you end up getting tax deduction. So for assets, it's typically the amount deductible against the future profits. For liability, it is the carrying amount less any amount deductible in the future. Okay, so for asset, any amount which will be deductible in future. For liability, pick up the carrying amount, reduce any amount which will be deductible against that liability in future. That becomes tax base of that liability. Let's see an example. Same machinery with a tax depreciation of 40,000. So in accounting, we charge a depreciation of 10,000, whereas in tax, we are charging a depreciation of 40,000. So what will be the tax base? Tax base will be 1 lakh rupees gross cost, 40,000 WDV. So my tax base will be 60,000. Another example, warranty provision. Company made a provision of 50,000. So book base will be what? 50,000. What will be the tax base? Tax base will be 0. Why? I'm saying my carrying amount of the liability is 50,000, and how much deduction I will get against this liability in future. I'll get a deduction of 50,000. So 50,000 minus 50,000, that gives me a tax base of 0. So 60,000 tax base for asset, machinery, and 0 tax base for warranty provision. So that if you see complete difference in approach, how we identified those timing difference in AS 22, whereas how we are working on these differences under Ind AS 12. And that is what we call profit and loss account approach versus balance sheet approach. The entire focus under Ind AS 12 is on balance sheet. And when we say balance sheet, we have to parallelly draw effectively a tax balance sheet. We always have our accounting balance sheet, and parallel to that, we draw a tax balance sheet, and then we calculate those differences. So continuing with, let's say this is an illustration of how a balance sheet approach looks like. So we have on the asset side, machinery, the net book value, and other assets. First column says accounting base, the second column says tax base, and then they identify temporary difference. So machinery, net book value is 90,000 and tax base is 60,000. That results in temporary difference of 30,000. And we are saying it's a taxable difference. And if it is a taxable difference, it results in deferred tax liability at a rate of 30%. It results in 9,000 rupees deferred tax liability. There are other assets where accounting base and tax base is same, and hence it's not resulting in any temporary difference. Corresponding to assets, we see liabilities, same approach, accounting base versus tax base. So provision for warranty, we have a provision for 50,000 warranty, and tax base we said is 0. Is it a taxable temporary difference or a deductible temporary difference? It's a taxable deductible temporary difference. So it's deductible, and hence it will result in deferred tax asset. So company records, subject to additional criteria given in AS 22, we'll talk about that. Deferred tax asset of 15,000. Other liabilities 100,000. So both under tax and accounting. So no difference in other liabilities. So just for presentation purpose, what is your net deferred tax liability? You have a deferred tax asset of 15,000, and we have a deferred tax liability of 9,000. So it's a net deferred tax asset of 6,000. And if you compare a profit and loss account approach under income statement, where we take accounting profit versus taxable profit, whereas in Ind AS 12 we are not starting with taxable profit or accounting profit. We are comparing the differences between accounting base and tax base, and based on that we are identifying temporary differences and then marking them as either deferred tax asset or a reversible difference or taxable differences, which results in deferred tax asset or a liability. Okay. So I previously said that all these differences will either result in deferred tax asset or a deferred tax liability, right? But when we identify each of these differences, sometimes it becomes, we have to obviously apply our thinking and assess whether those differences are going to result in deferred tax asset or a liability. Here is the summary, which can generally be used as, let's say, as a reference tool for quickly identifying whether a difference is resulting in a deferred tax asset or a liability. So generally, when you're accounting, when your book base is lower than your tax base, in case of assets. So we are categorizing our balance sheet into 4 categories: differences in asset, differences in liabilities, and in differences in asset, whether my book base is higher than tax base. Second, whether my book base is lower than tax base. Similarly, in liabilities, whether my liability book base is higher than tax base and whether my liability book base is lower than tax base. Depending upon that difference or comparison, it will either result in deferred tax asset or a liability. So if my book base is lower than my tax base, so in first example, book value is 100 and tax base is 150, it will generally result in deferred tax asset because you are going to claim higher depreciation in future because your tax base is higher. Opposite of that, your asset book value is 200 in number 2 and your tax base is 150. So your tax base is lower. When in case of assets, tax base is lower, it generally results in deferred tax liabilities. Moving on to liabilities, if your deferred if your liability as per books is lower than tax, it will generally result in deferred tax liability. And lastly, if your liability as per books is higher than tax, compare it with warranty provision, where warranty provision in books was 50,000 and tax it was 0. So your book liability value as per books is higher than tax base. It will result in deferred tax assets. Yeah, so this is a summary which can be used for identifying various differences as a deferred tax asset or a liability. Now let's quickly cover an example. It deals with revaluation, and this is one common or let's say typical example which also is an example where deferred tax may not be recognized under Indian GAAP AS 22, whereas the deferred tax will be recorded in Ind AS 12. So in this scenario, there is a property which is revalued from 5 lakhs to 7 lakhs. Tax base, so obviously tax do not recognize revaluation differences. So there will not be change in tax base. So your book base has moved from 500,000 to 700,000 and your tax base remains 500,000. So it will create a temporary difference of 200,000. Okay. So in this case, you end up recording a deferred tax liability, right? Because your book base is higher. When your book base is higher, what will you do? You will end up charging higher depreciation in future, right? It's a reversible temporary difference. And here you recognize a deferred tax liability. And at the end of the slide, you see AS 22 does not account for revaluation difference as it focuses on timing differences, which is profit and loss account. So this is a classic example where your book base and tax base, there's a difference. Just because it has no tax consequences doesn't mean that under Ind AS 12 we will not recognize any deferred tax on that. And as the asset is depreciated over a period of time, you will see that deferred tax difference is also reversed through profit and loss account, and it all that account also disappear as the asset is fully depreciated. So this is one example. Again, it is applicable when if an organization has done a revaluation. The other important point under Ind AS 12, you see, it says where are they recording this 60,000? They're recording it in OCI, other comprehensive income. So that's a new term, or we know who practice Ind AS that we have this concept called other comprehensive income. So what happens in deferred taxes? Wherever the item on which deferred tax is created is recognized, the corresponding deferred tax will follow that. So revaluation reserve is recognized in OCI as per the provision of Ind AS 16. So since revaluation reserve is recognized in OCI, the corresponding deferred tax impact will also be recognized in OCI. It's not that deferred tax impact will always go to profit and loss account. So deferred tax impact follows the underlying item on which that deferred tax is likely to be created. So that's an important note here. Okay. Moving to measurement and presentation under Ind AS 12, current tax straightforward based on tax rates and laws at the reporting date. Deferred tax. Now here try to compare it what we read under AS 22. Deferred tax uses tax rate enacted to apply when the tax liability is realized and settled based on enacted and substantially enacted tax laws. For AS 22 also we said it's a similar. We said what rate we apply for deferred tax calculation, enacted and substantially enacted. So in this point, both AS 22 and Ind AS 12 are similar. What rate we take is enacted or substantially enacted. Now note the third point, deferred tax asset. For recognizing deferred tax asset, we said under Indian GAAP, we have to have a reasonable certainty, and in other cases, we have to have a virtual certainty. But in Ind AS 12, what does it say? A DTA is recognized only to the extent that it is probable that taxable profits will be available. So the focus has moved from reasonable certainty or from virtual certainty supported by convincing evidence to probable. So it's much straightforward in Ind AS 12. Probable, we all know what is probable. We say it's more likely than not. Similar assessment we do for recognizing provisions under Ind AS 29. Right? So we all are much more familiar with the probable, and for recognizing deferred tax asset in Ind AS 12, we apply the probable criteria. That it's probable that there will be sufficient taxable profits in future, which will help us recover the deferred tax asset. So you can mark this difference on AS 22 versus Ind AS 12. Now, some of the other interesting concept under this standard Ind AS 12 is group versus standalone, which is again different from Indian GAAP. So what happens in group versus standalone? We know in IFRS, we also have to do consolidated financial statements. So sometimes there are items on which there is no deferred tax is created in standalone financial, but there may be implication or items which might get recognized in the consolidated financial statements and on which the deferred tax needs to be created. One of the most common example is business combinations. So when an entity A, let's say entity A acquires entity B, entity A is going to consolidate entity B and they are going to record respective assets and liabilities at fair value. That fair value changes does not have any tax consequences, right? So that does not change the tax base. So in that case, there will be a difference between tax base and book base on which deferred tax may be created. Okay, so that's one interesting point in group versus standalone, which happens in Ind AS 12. The other is intercompany transaction, it's very interesting. Let's say there are related party transaction where one entity of the group has sold goods to another entity. Okay, and at the end of the year, those goods remain unsold to a third party. So entity A has sold goods to entity B, okay, and entity B did not sell it to third party before the year end. So it is still reflecting in their inventory. So in this example, entity A would have made profit on that goods which they have sold to entity B, and they would have paid taxes. Now at a group level, there will be elimination of this intercompany transaction. Right, so entity A will remove sales and entity B will remove purchase, but there's a tax outflow on account of profit made by company A. Right, so that also is identified. This is also a temporary difference identified under Ind AS 12, and it is a reversible difference because whenever entity B sells those goods to a third party, there will be a realized profit and a tax obligation will arise. So that is the concept of group versus standalone, that under Ind AS 12, you don't only look at the individual financial or standalone financials of the entity, but you also look for consolidated adjustments or consolidated tax base versus book base differences to see if there is any tax deferred tax implication. Very, very important. Standalone versus consolidated. The other important item where typically we do not record any deferred tax under Indian GAAP are undistributed profits of subsidiaries. Okay, what is this concept? Let's see. It can be subsidiary, it can be associate, it can be joint venture. There may be a deferred tax implication on undistributed profits as well. So let's say this example. There is an investment in subsidiary which a company has done, and the tax base of that investment is 800. Whereas book base is 1000. Okay, so you have recognized an unrealized profit of 200 in your accounting books, but obviously tax is going to tax it when you realize that profit. So there is a difference. If there is an unrealized profit, is it a reversible or non-reversible difference? It is going to be a reversible difference because this difference will disappear either when the entity distributes dividend or when that investment is disposed of. Right? So it's going to result in, is it a taxable temporary difference or a deductible? Taxable, because you are going to pay higher taxes in future. So this is a 200, you'll record deferred tax liability on this 200. However, there are two conditions which if met, you don't need to recognize deferred tax. So there is an exception. which has been given in the standard, that even if there's a book-based versus tax-based difference in your investment in subsidiary, you don't have to recognize that deferred tax if you control, as a parent, you control over the timing. The entity, the parent, investor or venture controls the timing of temporary difference. Who is going to decide whether the subsidiary is going to pay the dividend? The investor. Who is going to decide when the investment needs to be sold? The investor. So effectively, the investor is control the timing of reversal. Right? So you, as an investor, you are controlling the timing of the temporary difference reversal, and it is probable that difference will not reverse in foreseeable future. So first, you control the timing of the reversal, and second, in foreseeable future, you don't have any plans to either distribute those dividends or dispose of that investments. If these two criteria are met, even if there might be a temporary difference, companies are not required to create deferred taxes on them. Very, very important in large complex groups where companies have several investments over various subsidiaries, investees, associates, etc. This discussion becomes very relevant. And again, Ind AS 12 specific, no such assessment is done under Ind AS is done under AS 22. Now, moving on, measurement and presentation. So, current tax is recognized in profit and loss account. Deferred tax asset and liabilities presented separately in the balance sheet. Okay, so we discussed when we said in Indian GAAP, generally deferred tax asset and liabilities are set off. In Ind AS 12, deferred tax and liabilities are generally presented separately unless we meet this criteria: legally enforceable right to set off, and it is with the same taxation authority. So if in your case it is resulting in a deferred tax asset and a liability, right? If the question comes whether I can set off those deferred tax asset and liabilities, you can only if you have a legal enforceable right to set off and same taxation authority. This will be the case only when you have taxes with the same taxation authorities, because different taxation authorities do not allow set off of tax payable to one and tax recoverable from others. Also, we talked about standalone versus consolidated. So even if you might, let's say, set off in standalone financials of a company, but in consolidated accounts in India, you see, even if the entities are part of the same group, in Indian taxation, we do not follow the consolidation concept. Each entity is responsible for their own tax obligation. So if multiple entities are part of the same group and one entity has a deferred tax asset and the other entity has a deferred tax liability, in consolidated accounts, can we set that off? We cannot set off, because we don't have even though the obligation is with the same taxation authority. Let's say one company registered in Delhi and other in Mumbai, part of the same group, their obligation or asset may be with the same taxation authority, but they do not have legally enforceable right to set off, because the tax department won't allow that excess tax paid by company in, let's say, Mumbai can be set off against the potential tax obligation of company in Delhi. So that is the concept of setting off deferred tax asset and deferred tax liabilities. Generally, it is presented separately unless we can establish we have a legal enforceable right to set off and it is with the same taxation authority. So when you are dealing only with one legal entity, it's easy, generally can be set off. But when there are multiple entities and multiple jurisdictions involved, then you present deferred tax asset and liability separately. Moving on to the disclosure requirements, Ind AS 12 is highly, it requires a lot of disclosure. So that's an additional, let's say, efforts which are needed when we comply with Ind AS 12 as opposed to AS 22. There are limited disclosure requirement in AS 22, but under Ind AS 12, there are extensive disclosures which are required to be made. Detailed breakdown of tax expenses, your DTA and DTL breakdown. And the last one is most important, reconciliation of rates, current tax rate versus effective tax rate. That's one reconciliation which is required to be made under Ind AS 12, and this is very important. So what is this concept? Current tax rate versus effective tax rate. So current tax rate is simple. Let's say if company is paying 25% or let's say 30%, or an entity is paying that tax rate, they will add surcharge or other applicable rates. So in this example, let's say they are paying 30% current tax rate. What is effective tax rate? Right? Effective tax rate is basically the when how much taxes you are paying. Let's say you have paid a tax of 100,000 on your accounting profit. That 100,000 based on current tax is calculated on based on the tax rates. But when you will apply those tax rates or tax amount to your accounting profit, that rate will not be 30%. That, let's say in our example, comes to be 20%. So what we are saying, the current tax rate is 30% and effective tax rate is, let's say, 20%. The standard requires us to give a reconciliation of that effective tax rate and current tax rate. So company needs to give in their disclosures that what are the various differences, what are the various items which are causing this difference of 10%. Right, very, very important, and it requires a lot of efforts on the company's part, that they have to obviously identify those differences, which anyway they have done as part of the deferred tax assessment, and mark the tax impact of those differences to reconcile that 10% difference. So in addition to various qualitative and quantitative disclosures under Ind AS 12, one of the most important disclosure requirement is the companies are required to provide reconciliation of their tax rates and your effective tax rates, current tax rates and your effective tax rates. If you go back and pick up, let's say any company's financials, let's say listed entities financial which are publicly available, and refer this disclosure, you will find that those companies have presented that disclosure and reconciliation between current tax rate and effective tax rate. Hope it's clear. Let's move on. Now, let's quickly cover some of the differences between AS 22 and Ind AS 12. We have during the discussion have covered most of them, but let's emphasize them once again. One of the most important item is Ind AS 12. We follow balance sheet approach, right? Focusing on temporary differences between carrying amount and tax basis. So entire focus shifts under Ind AS 12, where we move to balance sheet approach, and we compare the difference between tax base and book base. AS 22 income statement approach or profit and loss account approach focuses on timing difference between accounting and taxable income. So entire approach is different. Under Indian GAAP, we follow profit and loss account and just the reconciliation of accounting profit versus book profit, and mark those differences as taxable and deductible. But in Ind AS, we do the whole recasting of balance sheet as per tax and compare those differences, and then calculate deferred taxes. Ind AS generally results in broader differences, or let's say revaluation, while AS 22 will always have limited issues. Because your focus is on balance sheet, it's highly likely that the number of items on which deferred tax is being created under Ind AS are much more than AS 22. And also because of the standalone versus consolidated approach, you will have higher number of items on which deferred tax is created under Ind AS 12. Key difference in deferred tax recognition. In Ind AS, when do we record deferred taxes? We assess based on probability. If it is probable that you will have sufficient taxable income in future to offset deferred tax asset, we record deferred tax asset in Ind AS 12. And what was the concept under AS 22? First, we assess reasonable certainty. Deferred taxes are recorded if there's a reasonable certainty, and if you are an entity which has unabsorbed depreciation or carry forward losses, you apply even stricter criteria, which is virtual certainty supported by convincing evidence. So that's one big difference. So let's say when we say when we apply probable criteria versus we apply reasonable criteria, which is much more stricter? Probable criteria is much more stricter, or reasonably certain is much more stricter? So answer is reasonable certainty is much more stricter, and virtually certainty is even much more even more stricter. So what is the conclusion here? That Ind AS 12 is likely to result in more deferred tax asset as opposed to Indian GAAP, because the Indian GAAP has stricter criteria for assessing the availability of future taxable profits. Those criteria, if even if they do not meet the test of reasonable certainty or virtual certainty under Indian GAAP, it might be possible that they meet the probable criteria under Ind AS 12, and hence the deferred tax assets which are not recorded under Indian GAAP are recorded in Ind AS 12. So that's one difference. So if someone says, okay, in which standard it's likely that deferred tax asset is going to be recognized, then our answer is Ind AS 12 is likely to result in deferred tax asset recognition as compared to AS 22. Other difference, DTL recognition, all taxable temporary difference and all timing differences. So little straightforward, but the way these differences are identified is completely different. In AS 22, we identify timing difference using profit and loss account approach, whereas in AS 12, we use it, we identify those differences using the balance sheet approach. Initial recognition exemption, we discussed very briefly that Ind AS 12 gives us certain exemptions in which even if there is a difference between tax base and book base, there may be situation where we do not record deferred taxes, whereas AS 22 does not have any such exemption. So one of the example we discussed here is goodwill. So some of you who are familiar with let's say business combination accounting, Ind AS Ind AS 103 business combination. So whenever an entity acquires another entity, all the assets and liabilities are to be fair value. That fair valuation is compared against the consideration, the price paid. Any difference is recorded in goodwill. So let's say if an entity has paid 100 for acquisition and the fair value of all the assets and liabilities is 80, where will the difference be recorded? Under Ind AS 103, it will be recorded in goodwill. Now, while goodwill is recorded in the consolidated accounts of this entity, whether goodwill is recognized by tax authorities, right? So in our example, we have recorded a goodwill of 20, but under the tax, that goodwill will not be acknowledged. So what will be the tax base of that goodwill? 0, right? So accounting base of goodwill, in case of business combination, you have 20, whereas the tax base is 0. Now, based on whatever we have discussed so far, do we need to record deferred taxes on that difference? There is a tax base 0, there is a book base 20, and there is a difference. So going with whatever we have discussed so far, we need to record deferred taxes on this 20. That's where the Ind AS 12 gives us exemption, that when we have an initial recognition of goodwill arising out of a business combination, we do not have to recognize deferred tax on that. There are other assets also which we'll cover when we talk about updates, but this is important in a sense that when if you're dealing with a business combination and you recognize goodwill, you will see that we do not recognize deferred taxes on goodwill. Okay, and that is the reason, because Ind AS 12 specifically permits that exemption that you don't have to. And last comment, we said, okay, AS 22 deals with prescribes the stricter DTA criteria for limited recognition compared to Ind AS. Ind AS is little liberal because it talks about probability criteria. Disclosures differences. As I said, Ind AS 12 is much more extensive in terms of its requirement on disclosures, and one of the key requirement is around effective and current tax rate disclosures. And presentation difference, we said deferred taxes are presented separately in Ind AS 12 subject to that criteria, whereas in AS 22 we set off or we present deferred tax asset and liabilities on a net basis. Ind AS 12 requires more detailed reconciliation, and it is obviously aligned with IFRS, which is IS 12. So what are some of the practical implication of these differences? This is most, let's say, one of the important slide. Ind AS, I made this comment, Ind AS 12 is likely to result in higher DTA DTL because of balance sheet approach. So similar to that point where I said, okay, which standard is likely to result in deferred tax asset, AS 22 or Ind AS 12, we said, okay, Ind AS 12. Similarly, which standard is likely to result in more temporary difference, which will give rise to DTA, DTL, Ind AS 12. Why? Because we simply follow balance sheet approach. Financial reporting, Ind AS may result in higher DTA recognition, impacting reportable profits because of probable criteria. Third, I think is very important, especially when some of us are dealing with a group with multiple entities and we have to do consolidation, group versus standalone deferred tax calculation. You will see that many are able to easily record those deferred taxes on standalone financials, but when it comes to consolidated accounts, there are many items in asset and liabilities which are recorded, which will warrant recognition of deferred tax. And a couple of items which we spoke was intercompany transactions as well as unrealized profits of investing company subsidiaries. Complexity, Ind AS 12 require more judgment, assessing probability, while AS 22 is virtual certainty is stricter but clear. So which is more subjective? So probability, what is probable, what is not probable is obviously difficult to assess. But when someone says it's virtual certain, it's very demanding, right? So more likely than not, you are going to spend more time in assessing whether something is virtual certain as opposed to something is probable. So assessing probable is more cumbersome than virtual certain. Significant disclosure requirements under Ind AS 12. And lastly, compliance. Ind AS 12 aligns with global standards, aiding multinational entities. So if you are a large company or you are an entity which operates in various geographies, India, US, Europe, or other parts of the globe, then when you are applying Ind AS 12 as opposed to, let's say, AS 22, your comparability is enhanced. I mean, you will not apply Ind AS 12 on a standalone basis, you will apply Ind AS. So companies which follows Ind AS, their financial statements are much more comparable as opposed to when someone is following Indian GAAP. So these are some of the practical implication of these differences. Higher areas of difference in DTA, DTL, likelihood of recognition of deferred tax asset in Ind AS 12, group versus standalone, and much high additional disclosures in Ind AS 12. Now moving on to a couple of updates. This is important. I think this one which we are going to discuss now is very important. It deals with deferred tax on single transaction under Ind AS. When we talked about initial recognition exemption on goodwill, we said that when someone is recording goodwill, we don't need to record deferred taxes on that goodwill. Similar to the goodwill, there are a few other instances where there may be differences between tax base and book base on initial recognition. So this initial recognition term is very important. When I say initial recognition, what does it mean? Generally speaking, when we record an asset or a liability initially, it do not give rise to a difference between tax base and book base. So let's say you buy an item of plant and machinery at 100. What is our book base when we purchase that machinery? 100. What is our tax base? 100. It does not give rise to any tax difference, right? But there are instances when at times when you recognize an asset or a liability, there may be a difference between deferred tax between an asset book base and tax base. Goodwill was one example which was giving to difference between an asset tax base and book base. Let's see what could be the other case. We all are now familiar with Ind AS 116, accounting for leases, the new lease standard, right? What is the requirement of Ind AS 116? What happens at initial recognition? What do? We recognize something called ROU, right of use asset, creates a deductible temporary difference, and we correspondingly, when we recognize the ROU asset, what do we recognize? We recognize lease liability, corresponding lease liability, creates a taxable temporary difference. So when we are recognizing ROU, let's say a company records an ROU of 100 on day one in accounting. What happens in tax records? Whether tax authorities recognizes ROU? Obviously no. For them this will be zero. So tax base will, in this case, let's say when company is recognizing ROU, the tax base will be zero, whereas the book base is 100. Corresponding to your ROU asset, under Ind AS 116, what will we do? We will recognize a liability, lease liability of 100. Again, that lease liability will be accounting liability. There will not be any recognition of that liability in tax. So we have a difference both in asset, temporary difference both in asset and in liability. And as per the requirements which we have discussed under Ind AS 12, whether we need to recognize deferred tax asset or a liability on this, typically when we say, okay, if there's a difference between tax base and book base, deferred taxes are to be recognized. Now this is a case where there is a difference, where there is a difference in tax base and book base on, mark this line, initial recognition. Okay, initial recognition. So before this amendment came in 23, companies were not required. They got covered under that exemption criteria of Ind AS 12, where on ROU asset and lease liability, they were not recognizing deferred tax asset or a liability. Because the Ind AS 12 had this requirement similar to goodwill, which we discussed. If I just move to the previous slide, exemption goodwill. So we said on goodwill, we don't have to record deferred tax on goodwill on initial recognition. Similarly, there was this requirement under Ind AS 12 before this amendment that if an asset and a liability is recognized on initial recognition and it do not give rise to any difference in accounting and taxable profits. It do not create any difference in taxable and accounting profit. You don't have to record any deferred tax on that. So what was happening when on day one you are recognizing the lease liability and ROU asset, whether you are recording any tax profit or accounting profit on the date of recognition, on the date of initial recognition, the answer is no. So it was getting covered under that exemption and entities were not recording deferred taxes on this. But logically speaking, should we be recording deferred taxes on this? Because this is going to, ROU asset is going to be amortized or depreciated over a period of time, and lease liability also unwind as the lease payments are made. So this is what this exemption covers, that if you are recognizing Ind AS, you're recognizing ROU asset or a lease liability pursuant to Ind AS 116, this exemption under Ind AS 12 will not be applicable, and the company will have to recognize deferred tax asset and liabilities on these items. Right. So what is written here? Let's see. So under the new rule, deferred tax asset must be recognized both on the assets and the liability side. Okay, so on this 100 asset and 100 liability, let's say the rate is 30, you will recognize a deferred tax asset of 30 and deferred tax liability of 30. And it's important to note that while on day one, both the deferred tax asset amount and liability amount is same, but as we progress into the year and at the end of, let's say, 1 year, the reversal pattern will not be same. The asset will be depreciated using the useful life, where lease liability will be unwinded using the based on the payment. So after a year, you will see that both the amount of deferred tax asset and liability will be different. So this 23 amendments to Ind AS 12 notified by MCA. Let's read what is written. Remove the initial recognition exemption for leases and decommissioning liabilities. Okay. Mandate recognition of deferred taxes for both asset and liabilities arising from single transaction, right of use and lease liabilities. So what are we saying here? Essentially, Ind AS 12 permits entities to not record deferred taxes if asset and liabilities are recognized on initial recognition and they do not result in any accounting or taxable profit mismatch. However, this exemption will not be applicable to lease assets lease assets and liabilities recognized pursuant to Ind AS 12 and decommissioning liabilities. Hope this is clear. Now we discuss about lease. This amendment also talks about decommissioning liabilities. Now, some of you who have dealt with fixed assets, property, plant, and equipment in Ind AS 16, we have this concept of decommissioning liabilities. So, when let's say if you have taken an asset on a lease or a large mining at lease, there is a requirement that when you vacate those properties, you have to bring the land or the relevant space into the same condition which it was when the property was given. And if you have installed large pieces of equipment and machinery, there can be significant decommissioning cost. So under Ind AS 16, companies are required to make a provision for those decommissioning liabilities. Now, again, similar to leases ROU recognition, there was no deferred tax which was being recognized on those decommissioning liabilities. So after this exemption, after this amendment, the companies will be required to recognize deferred tax liability or asset on these decommissioning liabilities as well. So it's an extension in a way that the initial recognition exemption which is given under Ind AS 12 is no longer applicable to leases recognized pursuant to Ind AS 116 and decommissioning liabilities recorded under respective standards, specifically Ind AS 16 property, plant and equipment. So what does this amendment does? This amendment narrows down the scope of initial recognition exemption. Deferred tax must now be recognized on temporary difference arising from leases and decommissioning liabilities and applies when a transaction gives rise to equal amount of taxable and deductible temporary difference. In this case, there will be equal amount of deductible, like in lease example, we saw on the next slide that you will have the same amount of ROU asset and liability, but you still recognize the deferred tax in that. So that is this amendment. Moving on the next one. This is, I'll say, a little theoretical at this stage because it's still in draft mode, but important. It's called Pillar 2 Model Rules. So what does it say? The Pillar 2 Model Rule developed by OECD, Organization for Economic Cooperation and Development, and G20. It ensures that large multinational enterprises, MNEs, large multinational enterprises, whose global revenues exceed euro 750 million, they pay global minimum tax of 15% in each of the jurisdiction where they operate. So if you are an enterprise, multinational enterprise, and if your global revenue exceed euro 750 million, then the idea is that they pay minimum of 15% in each of the jurisdiction where they operate. You know that, I mean, some of the large organizations which operates in almost every country, they have this tax haven. They do extensive tax planning whereby they get away from tax payments in certain jurisdictions, or they try to bring all their profits to their home country and try to minimize their tax obligations in maximum number of countries where it's possible. So this tax amendment, or it's a global, let's say, global cooperation. It's not only an India kind of driven initiative. Objective was that all these government came together and they said, okay, we have to have a mechanism whereby these entities don't get away by not paying taxes, even though they are making significant profits. And we put a cap, we put a threshold that a bare minimum they have to pay 15% taxes in each of these jurisdictions. Right? This is, as I said, this is amendment, but this is still an amendment, let's say in Ind AS 12, but draft stage, it has not been implemented. So we are still discussing. Whenever it will be part of it, we'll see. It's called Global Minimum Top-Up Tax. So now let's analyze. When this provision becomes applicable, will it result in a deferred tax implication for any entity? Now, let's take an example of, let's say, Microsoft. Okay, Microsoft operates. They have their headquarters in US, and let's say if they have one of the entity in some part of Europe, okay, which is making profit, and that entity is only making in that geography, that entity is paying 5% tax. Right? What will happen after this provision? That entity will now be required to pay 15% tax, right? Not 5% tax. So at Microsoft console level, is there any the tax obligation increases? So question comes whether they need to make a deferred tax provision. Typically, yes. The answer will be yes. They might have to make a provision on that increased tax liability. So that's what this Pillar 2 model rule says, that what the standard try to acknowledge, and it's coming from IS 12, which says that while logically and conceptually this results in deferred tax implication, but the efforts and resources needed to make that obligation will probably outweigh the cost, and hence they took a call that in such cases no deferred tax are required to be recorded. So the whole exemption talks about the fact that for companies who are falling in this criteria, first of all, they have to have euro 750 million euros consolidated revenue. And if they have that, then they have to pay minimum 15% tax in the jurisdiction where they operate. If they meet this criteria, this implication is there. But standard tries to say, okay, even if you are falling in this criteria, you don't have to make a tax provision, or you don't have to provide a deferred tax on this. Okay, so that's the another amendment. Okay, but when you are taking this exemption, there are still significant disclosure requirements. What all entities will disclose? Entities must disclose the fact that they have applied the temporary exception. So obviously they have chosen to apply this exemption. Qualitative and quantitative information about their exposure to Pillar 2 taxes at the reporting date. So they have to give a detailed description of what kind of exposure they have under this model, and what are the potential top tax liabilities. If the Pillar 2 legislation is enacted or substantially enacted but not yet effective, entity must disclose that fact as well. So it might be possible that it is enacted or substantially enacted. Entity must disclose known or reasonably estimate about that impact. So while you are not recording the deferred tax asset or a liability of this obligation, but you will still make these disclosure required by the standards. Okay. So that's the overview of AS22, which we discussed, and Ind AS 12, coupled with some of the updates. So what are the key updates? What are the key takeaways? Ind AS 12 follows the balance sheet approach, broader deferred tax recognition, and it is IFRS aligned. AS 22 income tax approach, stricter deferred tax asset criteria, and practical impact. Ind AS enhances global comparability. AS 22 simpler but less flexible. Ind AS 12, deferred tax are calculated at consolidated level as well. Significant disclosure requirements under Ind AS 2, right? Including the tax reconciliation. So balance sheet approach, profit and loss approach, temporary difference, timing difference, and then deferred tax asset recognition based on probability criteria, deferred tax asset recognition based on reasonably certain / virtually certain, supported by convincing evidence, standalone versus consolidated differences, initial recognition exemption, and then extensive disclosures, including tax rate disclosures. Right? All these standards are mature. I think it's not that these are new. We have been applying them for several years. So I hope you found it useful, and I think we are slightly ahead of time. So which gives us more time for Q&As. So happy to take the question and answers, Q&As, and address them as appropriate. Shubham?
Yeah. So I think the one common question coming from the audience is, how should interest and penalty related to income tax should be treated under Ind AS?
Right. So yeah, interest and penalty is a very common problem which we all of us face. So now, while Ind AS 12 do not have, let's say, does not have this specific concept about permanent differences, but it uses the term temporary differences, right? Which means that it indirectly acknowledges that there may be instances of limited permanent differences, right? Which will not give rise to deferred tax under Ind AS 12 either. So coming back to this example, penalties and interest under income tax. Now, when we are paying any interest and penalties, is there any balance sheet implication, first of all, there? Right, we generally pay whenever we make a provision, or let's say they are paid when the return is filed, right? So generally they may not have a balance sheet implication, and but even if there's a balance sheet implication, you will say you have a tax book base, you will have a book base, but your tax base will be zero because you are not going to get any deduction of that difference, right? But will you going to get any reversal in future either? Neither they are going to reverse in accounting or nor going to get reverse in taxation. So taxes and penalties under paid to income tax authorities have a similar treatment as we have under AS 22. They are treated as permanent difference and they do not give rise to any deferred taxes in Ind AS 12.
Sure. I think another question coming is, how should intra-group profit on inventory be treated in consolidated financials for deferred tax purposes?
What did he say? Provision on inventories.
Intra-group profits on inventory.
Yeah. So remember, I covered that it is part of it as part of group versus standalone. Let me just quickly show that so that I think it's beneficial to all. Yeah. So you see second last comment on this slide, group versus standalone intercompany transaction. So what happens in intra group profit? So let's say I covered that example. So let's say company A has sold goods to company B. The cost of those goods was 100 and they sold it for 150. So company A made a profit of 50 on that, and they obviously pay tax on that 50. It's a group company transaction. At the year end, those that inventory was not sold by company B, so it was lying on their inventory. And now, when the consolidation happens, this transaction will be eliminated. The sale and purchase will be eliminated, and the profit of 50 will also be eliminated. But company A would have paid, let's say, 30% tax on that 50, which means there's a tax impact of 15, 30% of 50. So that 15 in the consolidated accounts can be recognized. So now let's go to the balance sheet approach. When the accounts are consolidated, at what value that inventory is reported? 100. But at tax base, at what value that inventory is reported? 150, because you have already paid taxes, right? So your asset base is higher, and then when the asset base is higher, it results in deferred tax asset or a liability. It gives rise to deferred tax asset. So in this case, that 15 intra-company profit tax impact on those intra-group profits will result in deferred tax, and that is required to be recognized under Ind AS 12.
Sure. I think we'll take some few questions also for the larger interest of audience. I think the question is, if withholding taxes are non-refundable and calculated on a gross amount, how are they treated under Ind AS 12?
So withholding tax is as good as your current tax, isn't it?
Right.
Right. So withholding tax is effectively, let's say, if company does a TDS, if any vendor, if company deducts your TDS, you have a withholding tax which you apply against your total tax obligation of that year. Right. If your taxable income for that year is not sufficient to absorb those withholding tax, then you generally claim a refund in India. But since you mentioned they are not refundable, then obviously it is more like a permanent difference, and you won't do any. You will not have any impact on that from a deferred tax perspective. Again, the same concept. Withholding tax becomes your asset for tax purposes, advance tax, right? Again, you will have a tax base, but you will not have a book base. Or you will have a book base, and then you compare with the tax base. The fact that you mentioned that it will not be deductible, so effectively your tax base might become zero, which is non-reversible, and you will not record any deferred tax on that. But generally, again, unless you are dealing with some foreign jurisdiction where withholding tax may not be refunded, but in India, if your withholding tax is in excess of your tax obligation, you generally get a refund.
Sure. I think another question is, in case of presumptive taxation or tax based on gross measures, does Ind AS 12 applies?
That's a very interesting question, and it's a common, let's say, common point which comes in most of the people's mind. So I think idea is not to see whether presumptive income or regular income or capital gain that results in income tax applicability of Ind AS 12 or not. And all of these are coming from that same fact of profit and loss approach, which typically we have been applying under AS 22. When your entire focus, so going back to the basics, whether Ind AS 12 is applicable or not. Answer is simple. Ind AS 12 is applicable to any entity which is following Ind AS. Right? Now, when you are following Ind AS, you have to apply Ind AS 12 also. Right. When you apply Ind AS 12, you simply follow the principle of balance sheet approach. Now, in your case, when you are doing presumptive income, right? Presumptive income says you don't maintain fixed, let's say, detailed books of accounts, etc., because of the size considerations and all, and you apply a XYZ tax rates. So, let's say 6%, 8% of your revenues, and you pay that tax. Now, when you are paying that tax, what is the balance sheet implication you are having? Same tax under, so you will pick up each and every item of the balance sheet, your fixed assets, your inventory, your investments, your prepaid expense, your liabilities, etc. This amount will fall anywhere? Highly likely, nowhere. It will not fall anywhere. So there will not be any tax base or any accounting base. Answer is no tax implication or no deferred tax implication. But does it mean that you take a view that you don't apply Ind AS 12? Answer is no, because you will be still subject to disclosure requirements.
Sure.
And people, again, hopefully it helps. And since we have time, feel free to ask follow-up questions to your query. I mean, happy to make use of this time.
Yeah. So I think another question, which Ind AS should be referred to for taxes which are not covered under Ind AS 12?
So that's an interesting question. So, I mean, if you see the heading of the sections, heading of the standard, it says income taxes. Right? So we all know this concept of direct taxes and indirect taxes. Right? So any tax which are levied on the income of an entity, that's where you will come into Ind AS 12 domain. So if you are dealing with GST, VAT, or taxes which are not based on income of an entity, that's where you will apply other standard. Right? So very simple, income tax. And again, different Indian income tax is still simple because we operate under a federal tax structure. We have one tax authorities. So this question doesn't become so complicated for us in India. But if someone who deals with, let's say, US taxation, there you have state taxes, federal taxes, and which are based on income. There it becomes a little extra exciting for professionals. So yeah, I think the bottom line is income taxes gets covered under Ind AS 12, and all other taxes gets covered. You apply all other standard as applicable.
So I think one interesting question which is coming is, how should an entity account for uncertain tax positions that are probable but cannot be reliably measured?
Okay, UTPs. Uncertain tax position is obviously a very interesting concept. And I purposely, honestly, sorry for that, I did not cover it because it has different complexities and gets a little more technical. So UTPs, as the name suggests, uncertain tax positions. So let's understand, what is a tax position? You pay a salary to an employee, okay? And you claim that as a tax deduction. So you have taken a tax position that this expense is deductible for tax purpose. Simple. So any position for an item of income and expense which you take with respect to what will be the treatment of that position in tax, that becomes your tax position. Now, majority of the times we are clear that what is the tax treatment. Let's say salary expense, gratuity, sales, or provision for doubtful debt, bonus, procurement, all of that. But sometimes there are significant tax positions where you are not so sure about the tax treatment. It's gray. It's you are taking a certain tax position, whether the income is exempt from tax or an expense is eligible for deduction, but it is not as black and white. And the moment you bring in this angle of uncertainty, what you are saying, the position which you are taking for tax purpose is uncertain. That is why the name given, uncertain tax positions, right? So standard has this requirement that if you have certain uncertain tax positions, you are going to make an assessment on the probability of that position getting sustained. So if you have taken a position that certain income will not be taxed and hence you have not paid tax on that, or you have taken a position that an item of expense which you are claiming for deduction will not be allowed for deduction, and you are uncertain about it, then you are going to do a probability assessment that it's probable that this position may not sustain, and if that position does not sustain, it will result in higher tax obligation. Make a provision for that. Now it's very ironical, and at times I also get confused with this. At one point you are saying it's uncertain, and if it is uncertain, why will you even claim that? So in the first instance itself, when you take UTPs and you are saying it's probable that it will not sustain, why will you even claim it? But the problem is, if you don't claim it, you are anyway not going to get a tax benefit.
Right.
If it is not in your return, why will assessing officer allows you? So companies obviously take those positions and they know it might get into a dispute, but then at least they know that they have a chance that they are likely to claim a deduction on that. So they take those UTPs, and then standard requires you to make those provisions, probability assessment on the likelihood of their sustainability.
Yeah, interesting. I think being an interesting topic.
I mean, we can have full-fledged session on that, but yeah, I mean, I purposely did not include in the coverage.
Yeah, I think if I take one question, so just to for the larger interest of audience, what is in the thumb rule which you will give for assets and liabilities for creation of DT or DTL? So if we have to summarize for DT and DTL, what is the thumb rule for asset and for liabilities?
Yeah, so thumb rule is what I covered in this slide, because I know what the problem comes. What I have realized in my own experience also, it's always easy to identify differences. We know, okay, these are deferred tax difference. The problem comes is, okay, whether it is a deferred tax asset or a liability.
Right.
And you keep thinking, okay, I know, is it liability, is it asset, and all of that. So generally, I mean, if your conceptual understanding is very strong and super strong, you will not have that challenge. But sometimes your understanding is also strong, but you don't have the time, right? We know how stressed timelines we all work in. So I generally refer this slide, okay, which gives a reckoner or a ready reckoner kind of a thing. Okay, if my particular difference is falling in either of these four categories, I take a decision that is it a deferred tax asset or a liability. So when I covered this slide, what did I say? Your difference will either be in the assets or liabilities.
Right.
Very clear. Then that difference either be your accounting base is higher than tax base, or your accounting base is lower than tax base. So effectively, you will have four categories of difference: two in assets, two in liabilities. Your tax base in asset is higher than liabilities. Tax base is lower than tax base of assets is higher than accounting base of assets. Tax base is lower than accounting base of asset. Similarly for liabilities. So here is the reference. If your tax base is higher, asset in assets. If your tax base is lower, liability. So in depreciation, remember we said 100,000. So let's see on the right hand side in case 1. Your machinery book value is 100 and tax base is 150. So your tax base is higher in asset. So thumb rule is, if your asset tax base is going to be higher than the book base, you are going to have a DTA. Opposite of that will result in DTL. Similarly, deferred tax liabilities. If your book base of liability is higher than, if your book base of liability is higher than, is lower than tax base, then it will be a deferred tax liability, and so forth. To make it more simple, what I remember always is third category. And once I remember third category, I am able to derive all other categories.
But I think we can simply say if we learn first two, I think reversal of first two is the second one.
Exactly. But yeah, that is also true. But if I have to remember only one, so I call it a principle of triple L. L. If liability is lower, it results in liability. So once I remember that principle, based on that, I'm able to derive all other three principles. So what I say is, if my accounting liability, number 3 principle, if my accounting liability is lower than tax liability, it will result in deferred tax liability. So principle of 3L. And once I remember that, I'm able to derive all other three principles.
Right.
So that's a thumb rule, or let's say quick reckoner. Some of you want to follow, you can.
And I think one more question which is coming is, can you just reiterate how to calculate the tax base of liabilities?
Yeah. That's also an interesting question. That also results in, let's say, confusion at times. So thanks for asking that question. And it's a very interesting observation. Whosoever has asked this question, thank you for that. If you see the definition of tax base on this slide, the way the definition of tax asset is given, the definition of tax liability is not given same way. So what does it say for tax assets? It's typically the amount deductible against the future taxable income. It's very simple, straight away. Whatever is your amount deductible in future, that becomes your tax base. Now read what it says for the liability. It doesn't say the same thing. Whatever is deductible for in future, it says take your carrying amount, okay, less amount deductible in the future. So you have to take additional step. First, take your carrying amount as per your liability, as per your financial, and then you calculate whatever is deductible in future. Why it is different? Please note, it's important. Okay. General presumption is the moment you recognize a liability, it is recorded in your profit and loss account. Right? So they are saying generally liability recognition will result in equal amount of tax base. So there will be cases, let's say warranty provision. What was happening in warranty provision? We recorded a warranty provision, but that was not allowed for tax. So what did we say? What was the carrying amount of warranty? 100,000. Now against that warranty, how much is going to be allowed in future? 100,000. So you are saying your carrying amount is 100,000, and from that you are reducing a carrying amount of future deductible amount, which is 100,000, which gives you a tax base of 0. And then you will compare your accounting base 100,000 liability and tax base 0 gives you a difference of 100,000, giving rise to a deferred tax asset of 30,000 if 30% is the tax rate. So conceptually it's same, but the way it is defined is obviously different for the reason which I just mentioned.
Yeah. I think whosoever asked is a good question.
Yeah.
Next question coming is, under what condition can a company recognize deferred tax assets on carry forward losses? What kind of evidence is required? I think broadly you covered, but I think if you could touch upon the same.
Right. So again, first I'm assuming, let's see, so AS 22 versus Ind AS 12. Okay. So if an entity has brought forward losses, so let's first understand the concept. What we are saying is that recognize deferred tax asset. What is the very basic definition of asset? Asset is a resource controlled by an organization, right, which has arisen because of the economic outflow in past, and it is expected to give rise to economic benefits in future. Asset means what? You will recover in future. How? When we purchase a plant and machinery, how do we recover it? Through usage. When we have accounts receivable, AR, how do we recover? By collection. So an asset is always recovered either through usage or through realization. Now, when the standard is saying you can record deferred tax asset, when I'm recording deferred tax asset, I have to meet this criteria of realization. My asset should not be bad at the time when I'm acquiring it. So same criteria needs to be applied to deferred tax asset, that my deferred tax asset, there should not be any doubt on the realizability of those deferred tax asset when I'm recognizing it. Okay, so that's where standard Ind AS 12 says, if it is probable, and how will you recover your deferred tax asset? You should have sufficient future profits so that you pay lower taxes in future. So if you have probability, it's probable that you will have sufficient future profits, so you will recognize deferred tax asset. Because you will be able to recover. Now imagine an entity which is running losses. Now an entity which is consistently making profit of, let's say, 10% of their turnover versus an entity which is making losses. Now, for which entity you think it is probable that sufficient future profit will be available to offset the deferred tax asset? Entity which is making profits or entity which is making losses? Obviously, entity which is making profit. But if an entity is making losses and they say that they want to record deferred tax asset and they say that they are going to have a sufficient future profit, it invites a lot of questions. Right? It says, okay, how are you going to establish it is probable in Ind AS 12 or virtually certain supported by convincing evidence in AS 22? Right? So generally, practically, let's see, you will ask for business projections. First, when you have asked for business projection, you will see the company's past projections and actual performance against those projections, because company is always good in making wonderful projection that they'll grow at 20%, grow at 30%. But what is their past records with respect to meeting projections? In case an entity is loss making, then projection enough alone won't do anything. One of the most important item which they may need is signed highly profitable contract from a customer. So if they say that they have a contract with a customer and signed contract, not only a discussion or a negotiation, because that may or may not happen. And all of these are illustrative. The assessment in each of the case will be different. So the signed contract or favorable government regulations, which says, okay, even if you let's say reduction in GST or some economic policy which is going to result in increased profitability or market prospects. So it's a combination of many factors which when you are only doing probability assessment, when you are profit making, as opposed to when you are loss making, the criteria and the kind of documentation and discussion which you have are significantly much more stringent as opposed to normal case. And lastly, Indian GAAP is highly impossible that you will end up recognizing deferred tax asset if you are loss making. Ind AS you can still record because the criteria is less stringent because you use the term probable.
Yeah, I think most of the people must be facing this issue. So probably I think this has come in.
Yeah. But in my view, again, while it's good for academic interest, but practically speaking, it will be highly, almost impossible for an entity to record a deferred tax asset if it is loss making.
Right.
Because first, when an entity make a loss, first assessment what you do is going concern. Right? And when you do going concern assessment, after that you are saying, okay, you want to recognize a deferred tax asset. Asking for too much, to be honest.
Absolutely. I think another question which is coming is DTA detail required to be created on the fair value of financial asset and liabilities? Basically, the fair valuation of assets and liability, financial assets and liabilities.
Right. Okay. So point blank answer is yes. Now let's see conceptual answer. It's easy to let's say remember this, that yes, fair value is whether you need to record DTA, DTL on fair value. But now again, go back to conceptual. That's where Ind AS 12 becomes much more interesting than AS 22. Balance sheet approach. Okay, when you are doing fair valuation of assets, what will happen? Your accounting base will increase. I'm assuming you did an upward valuation. Your accounting base will increase. Will there be a change in your tax base? We covered that example, I think, of revaluation. Revaluation is good as fair valuation, right? When you are doing a fair valuation, your accounting base will increase. Will your tax base increase? Answer is no. Now, will there be a difference between your tax base and accounting base? Answer is yes. Is it reversible difference? Answer is yes. So, should you recognize deferred tax asset or liability? Answer is yes. So, whenever you get in this doubt whether the deferred tax asset, deferred taxes needs to be recorded or not, simple principle: book base versus tax base. Cast your tax balance sheet, the one which I showed here, this one. Accounting base, map the tax base, calculate the difference, you will get an answer whether you need to create deferred tax or not.
Yeah, I think last question which has come is, when an investor company receives a dividend from an investee and this dividend income is tax exempt in the investor jurisdiction, how is this transaction treated and accounted for Ind AS 12, particularly concerning the recognition of any deferred tax implications?
Correct. So his question is that there is a scenario where if you have a subsidiary, and whenever subsidiary distributes dividend, that dividend is tax exempt in the hand of the recipient.
Right.
So again, we cover this concept briefly. Again, I think this will help. Let me just see that undistributed profits of subsidiary we covered there, and let's see this one. Okay, here is, in this case, the only difference from the question which is asked is, in this case, in this example, slide number 17, we are saying the dividend is not exempt, right? And but in the question, the person has asked a scenario where dividends are exempt in the hands of the recipient. Now, if the dividend is exempt in the hands of the recipient, then again the question around the reversible versus irreversible or the permanent difference comes into picture. So the standard, again, in this case, if the dividend is exempt in the hands of the recipient, the person is not required to create a deferred tax. Again, mind you, when I'm making this comment, don't make this this application will not hold good when we go back to a DDT scenario, when we used to have dividend distribution tax, right? So in your example, I am assuming while the dividend is exempt in the hands of the recipient, I'm also assuming that the payer is not required to pay tax, something called dividend distribution tax, right? Which we used to have till 2020. So if it is a case where dividend distribution tax is there, then this guidance on undistributed profit still becomes relevant, because then the tax obligation has shifted from holding recipient to the payer. It's little tricky, right? So if there is no DDT and dividend is exempt in the hands of the recipient, we are not required to create deferred taxes on that.
Yeah, I think that's it. I think, Surendra, we don't have no more questions. I think finally, I think we should summarize the session. We should conclude the session. So I think thanks all. Thank you all thank you all the participants for your active engagement, truthful questions and time. I think your presence and involvement in making this session more insightful by asking questions, making more attention, and especially Surendra for giving your time and sharing such an insightful session with us. It's really been insightful and helpful for all the participants who have joined. I think thank you so much to all the participants and Surendra and the ICI team. I think thank you so much.
Thanks to everyone, and thank you ICI team and Shubham for moderating the sessions. Really thankful to all for giving me this opportunity to speak on this platform.
Yeah, thank you.
Thank you.